All right. Thank you for joining us. Good morning, everybody. We are going to talk today about mortgages, which I realize is exactly what all of you were hoping to discuss at 10 o'clock on a Friday morning. But I actually think this is one of the more important training sessions we can do right now with interest rates peaking once again and the buyer pool being softer than we'd like. If you don't know this statistic, 3 years ago, when things were good for a short period of time, 2021, 2022, there were about 7 million home sales in the US. Last year, we were down to 4 million home sales in the US, around half. This year's off again. And part of it has to do with people being locked into the rate that they have and not wanting to move. And we're going to talk about that a little bit today. Part of it has to do with people being scared about the economy, about all sorts of things. But one of the things Tim would tell you all day long is when Teresa and Tim and I started in this business, the interest rates were, 15, 16%. So houses can, and I know prices were a lot cheaper, but houses can sell in any market. Anyway, there we are seeing interest rates peaking once again. The buyer pool is softer than we'd like. So in those types of situations, we use mortgages and lending to try and generate more buyers. And the goal today is not to turn any of you into mortgage lenders. Caitlin, Paul, and the team at 21st Century Lending already have that job, and frankly, none of us need another job. What I want for you to understand today is enough about financing that when a buyer says, I can't afford to do that, or a seller says, I am never giving up my 3% mortgage, you don't just nod and let the transaction die. We want you to know enough to say maybe, but before we decide that, let's get a mortgage lender involved and see what the numbers actually look like. So today is really about three things: the process, the products, and how we can use financing as a marketing tool. And the reason this matters is that financing has moved from somewhere in the background of the transaction to right in the middle of almost every conversation that's happening at every kitchen table when people are deciding they can't fit in their house anymore. Last night, I accompanied Teresa on an appointment where they have one of her past clients bought a property 7 years ago, and they've been sitting on it wanting to move. They now have 4 kids. Well, they have 2 kids and they have twins on the way, in a 2-bedroom house, and they didn't want to give up their rate. So it's an interesting time. Buyers are confused. Sellers are rate locked. Have you heard that term, rate locked? And realtors are increasingly being asked to translate all that anxiety into a rational decision. Mortgage conversations aren't just something that happens after we write an agreement anymore. Financing affects whether somebody lists their house. It affects what they shop for. It affects whether their offer is even competitive. It affects inspections and appraisal issues and concessions and timelines, and obviously whether or not we're ever going to get to closing. So here's the opportunity. The agent who understands the process and can explain it calmly has an advantage. You don't have to have all the answers. In fact, I'd prefer that you don't pretend to have all the answers. You simply need to recognize when financing might create an opportunity and know when to bring in Caitlin or Paul or your mortgage partner, your mortgage lender into that conversation. Because as the slide says, the agent who panics first usually isn't the person who's invited back for pie. And I actually have no idea what pie has to do with mortgage lending, but it felt strongly enough to put it in this PowerPoint. So everything today falls into 3 buckets. First, I'm going to explain briefly the mortgage process, the application, the pre-approval, documents, underwriting, and closing. Not because you're going to do it, but because you need to know what's happening to your client. Second, we're going to look at product landscape that's out there. Too many of us look at conventional FHA, and we can't see beyond that. There's veterans loans, USDA for most of our market areas, renovation loans, we're doing one of those right now, investor products, DSCR loans I'll mention, bank statement loans, and several others. And again, you don't need to memorize all of these. What I want you to develop is that little light bulb in your head that goes off when a client says something unusual, and you think, wait a minute, maybe Caitlin or Paul has something for this. And third, we're going to talk about using financing as a marketing tool. That may actually be the biggest opportunity for us as realtors, because financing can sometimes change how buyers perceive a property without changing anything about the property itself. So my goal is that everybody leaves today with a few sentences that you can literally use this afternoon when you're talking to clients. Now, before we go any further, I need to make an important disclaimer. You are not the lender, so do not quote interest rates. Don't promise somebody a payment. Don't guarantee they're going to get approved. And don't start inventing loan programs while you're sitting at an open house because you vaguely remember something somebody said at a training 6 years ago. Our job is just to identify the possibility. Caitlin's job or Paul's job or your lender partner's job is to verify the path. And that's the phrase I want you to remember. If somebody says, I don't think I can buy because I only have this much money down, don't say, absolutely, you qualify for USDA loan. Say there may be programs that could help with that. Let me connect you with one of our mortgage professionals and have her look at your situation. That's safer and smarter and frankly much more professional. And there's another reason I'd love to see you using Caitlin in 21st Century Lending. They are our partner. Now, keep in mind, and I have to say this very carefully, at least two of our realtors are married to lenders. Hey, if you're married to a lender, use your partner, use your spouse. If you don't do that, you're going to be in a lot of trouble. And some of you have really great relationships built with people that are out there that you've dealt with a long time, and that's great, no problem. But our lender partner in the company is available to help our people strategize transactions. So take advantage of that. It also helps us to produce marketing when we're able to use some of our in-house services. We're able to produce more for our clients. If you haven't seen the home buyer guide that we've been dropping off at all the offices, we've been using that with our clients and meeting with them and giving them that. It's a great marketing tool, and I think you should use that when you meet with buyers for the first time. We also dropped off folders for your buyers at each of the offices that I think are pretty good as well. Now, again, don't wait until 3 days before closing to introduce yourself with, hey, Caitlin, you don't know me, but I've got an emergency. By the way, I think she goes by Kate. Sorry about that. So let me start with the first section today, which is the mortgage process. And I know this is the most dull part. I'll go through it quick. I'm going to move through this quickly because you don't need to be a mortgage underwriting person. You don't need a certification. What I want you to understand is what happens between the moment somebody says, yeah, I'd love to buy a house, and the moment somebody hands them the keys. And that's where we as realtors can accidentally make the process better or considerably worse. We are particularly talented at both. I'm going to describe this section of an application of how closing, what I'm trying to get across, sorry, I'm backtracking a little bit here, is I want to avoid or prevent mortgage file whiplash, which is spending a lot of time with a client that can't buy a property or having a problem come up later that could have been solved in the beginning. And that's a problem we run into too often with clients, right? And I'm going to open this up to some conversation in a little bit. This is the whole mortgage process in 7 steps. They make an application. They get a pre-approval. And one of the nice things about our mortgage partner here is they do give you a full pre-approval. They ask for documentation. They have an underwriting that will approve the loan. They're going to actually check everything and approve it. There might be some conditions on that loan. They're going to provide you what's called a clear to close, and then we do a closing. There's nothing terribly mysterious here, but almost every loan problem comes back to some version of missing information, unresolved risk, or an unrealistic timeline. We have them all the time. Missing information, unresolved risk, or an unrealistic timeline. And realtors do have an impact on this. We can control contract dates. Not saying we're going to get a loan approved and done in a week. We can help coordinate the appraisal process and access to get them in quickly. We negotiate repair language and seller concessions. In other words, asking a seller to pay for some of the buyer's closing costs. We communicate, or occasionally fail spectacularly to communicate when we have changes to the transaction. So even though we're not underwriting the mortgage, we absolutely affect whether that mortgage process goes smoothly. And that goal should be that Caitlin never has to call you and begin the conversation with, Loren, we've got a problem. Nothing good follows those words. So we want to try and control everything possible up front. The process starts with an application. The borrower is providing income, assets, debts, their employment history, their residence history, where they live, where have they lived, and permission to review credit. Now, those of you who are dealing with New York buyers, because there's a lot of them lately that are still working in New York and moving to the Poconos or moving to the Lehigh Valley or moving to Bucks County, there may be questions on, are they going to continue to work remotely or travel back and forth? Those sorts of things come up regularly with a mortgage lender asking questions. And the lender isn't merely asking, can this person get a mortgage? A good lender is asking, what's the best path for this particular borrower? And that distinction is important. When you're first working with a buyer, you should ask a few basic questions. Are you already talking with a lender? And by the way, if they say, yes, I went to one of those online lending companies, That's never, I shouldn't say it's never a great thing. It's often not a great thing because a lot of them are just like Zillow. They are lead factories. So you get to one of these online mortgage companies, and they're not really a mortgage company. They're really someone who sells mortgage leads to other people that are in other states that don't necessarily know the market. And then it makes it very difficult to go talk to them if there's a problem. I like dealing with somebody who's local because the rates are exactly the same. Have you actually completed an application, or did somebody just tell you over the telephone that you should be fine? Are you self-employed? Because self-employed borrowers need to show 2 or 3 years tax returns. Did you recently change jobs? If you recently changed jobs, I hope they're in the same field because that can affect their ability to get financed. Is part of the down payment coming from a gift? Because if it is, we have to show where that gift is coming from. We have to show that person's bank accounts, show that the money was in their bank account for at least 90 days, and get some sort of letter from them as a gift. Are there any credit issues that they have? And maybe most importantly, what matters most to you as a buyer? Is it keeping the monthly payment down to something that's more affordable? Or is it minimizing cash to close? Because it could be either. Some borrowers are not as worried about how much the monthly payment's going to be, but they have to minimize what they have up front. Some of them really want to keep their mortgage in line with their budget. Getting approved quickly, having flexibility, are those important to them? You don't need to solve these things. You need to recognize them and connect the buyer with a lender early enough that she can work through these. And that distinction becomes really important when we're competing for properties. A pre-qualification is basically a useful first look. Some information may still be unverified. A real pre-approval means the lender's gone considerably deeper. They've done a credit report, they've checked their income, they've looked at the bank statements and checked their assets, and the loan program may have been reviewed. And here's why you should care as an agent. A strong pre-approval when you're working with a buyer can make your offer stronger. A strong pre-approval can make your offer stronger. Think about being on the listing side. You've got two $400,000 offers sitting in front of you. One buyer had a 10-minute conversation with somebody over the internet. The other has been reviewed by 21st Century Lending, by Caitlin's underwriters. The documents are in, the credit's been reviewed, and the financing has been pressure tested. They're not identical offers. And yes, buyers can still write another paragraph about how much they love the breakfast nook, but I would take the verified financing first. So what do we actually want when we say somebody's pre-approved? We want an approval that has credit reviewed, income reviewed, assets, that's how much money they've got in the bank, reviewed, or gifts, debt to income checked, the loan program identified, and the timeline confirmed. And when I say debt to income, those are those qualifying ratios. Different loan programs have different qualifying ratios. So again, you don't need to know what those are. You should have an idea, but you don't need to know what they are. You need to be able to get a lender to work through them with you. And a pre-approval doesn't mean there's zero risk. Nothing in real estate has zero risk. We just had a transaction implode for one of our agents, unfortunately, where they found out later that the property needed flood insurance. And that flood insurance added $300 a month to the payment. That $300 a month payment on top of the mortgage kicked them out of being able to qualify. So those types of things can hurt. So we've had transactions where we weren't entirely sure the building would still be standing at closing. The purpose of a good pre-approval is to find the problems early enough that we can do something about them. And that's another reason I want you to get buyers to a mortgage professional early, not after they've fallen in love with a house and we're writing an offer in the driveway. Now, this is the part buyers love. Paperwork. Yes, they absolutely love it. I'm kidding. The lender may need identification, pay stubs, last couple of them, so you want them to collect those, W-2s, tax returns, bank statements, generally the last 3 months, investment statements if they've got investments, documentation on gifts if they're getting money from mom and dad or Uncle Charlie. And depending on the borrower, divorce decrees are very important because sometimes people are in the middle of a divorce when they're trying to buy another house. Leases, if they own a property that has mortgage on it and has rent, they're going to need to see the lease to be able to compute that in. Business returns if they're self-employed. Support orders if they're getting child support and other documents. And here's what I want you to tell your clients. Send everything. They're going to find it anyway. If the bank statement's 8 pages long and page 8 says this page is intentionally left blank, send page 8 anyway. Because I promise you, the underwriter has somehow been trained to know that page 8 exists. And second, don't start moving money around without talking to the lender. That creates red flags. And third, and this may be the most important mortgage advice you can give anybody, once you're under contract, please don't celebrate by buying a car, opening 3 credit cards, and financing $14,000 worth of furniture on the house you don't own yet. Every year we have 2 or 3 of these where the loan ends up getting into default, into a problem, not getting to closing, or having a risk of it not getting to closing, because right before closing, they put furniture on a credit card and bought a car. It happens a lot. Always talk to the lender. Don't buy anything right before settlement. It's a real problem for loan transactions. Now, we laugh about that, but every lender in America has a story about somebody doing exactly that. And again, the realtor's job is not to collect and evaluate all these documents. Our goal is to coach the buyer to respond quickly and let the lender handle the financial details and give them the best advice we can. Now, we get to the things that actually slow mortgage files down. Large deposits are one of the biggest ones. If $15,000 or $25,000 suddenly appears in the buyer's bank account, the underwriter isn't going to be impressed by their newfound prosperity. They want to know where it came from. They want to make sure it's not borrowed from somewhere. Self-employed borrowers can be another challenge because what somebody tells us they make and what their tax return says can be occasionally distant relatives. Missing pages are a third thing that are often a problem. If a bank statement says page 1 of 7, the underwriter wants to see pages 2 through 7. They apparently have no sense of adventure. Undisclosed debt eventually shows up. Oh, you found that car loan? Credit changes show up. And property repair issues can matter depending on the loan program. By the way, if you don't know this, the lender is going to run a credit report in the beginning. They're going to run a credit report right before the underwriter says yes. And they're going to run a credit report the day before settlement, which is how they catch that car loan and that new credit card with $14,000 worth of furniture on it. So we've got to make sure they don't do that. So one of our jobs is simply to warn buyers before these things become emergencies. And by the way, if they can't afford a mortgage, if they have a problem, we also have credit repair specialists that can help us. So that'll work with us over the next 6 months or a year, and you stay in contact with that client, and eventually they're going to be able to buy. And once again, this is where Caitlin or your mortgage partner helps. If something unusual is going on, like self-employment, or gift money, or large deposits that just happened, or credit issues, don't hide it and hope underwriting develops poor eyesight. Get the mortgage lender involved early. And once all that documentation is assembled, somebody has the delightful job of actually reviewing it. That's called the underwriter or underwriting. And underwriting really comes down to 5 things I've got on the screen. I've always said 4. Capacity, credit, capital, and collateral. And I also have here compliance. Capacity is, can they repay the loan? Those are your qualifying ratios. Credit is, how have they handled debt in the past? Do they have a credit score of 770 or do they have a credit score of 520? Capital is what assets and reserves they have. They've got to have enough money in the bank to actually finalize the closing. And collateral, that's your appraisal. Does the property support the loan? It has to appraise for enough to make it work. And compliance is, does the whole thing fit the guidelines of the loan program? Because different loan programs have different guidelines. FHA, 29% of your gross monthly income can be used for your mortgage payment. 41% can be used for your mortgage payment plus your car loan, your student loans, and your credit card bills. But conventional is going to be different. Conventional 3% down or 5% down or 20% down are all going to have different ratios. So that's really what the underwriter's doing. They're matching the borrower and the property against that set of rules. And underwriting is not personal, although I admit that it can feel personal when somebody asks you for page 6 of a bank statement for the 3rd time. And this is important for us as agents because when a client calls and says the underwriter's giving me a hard time, don't join the outrage. Instead, you're going to say, what are they asking for? Let's get the lender what she needs and get this moving. We're trying to solve a problem, not establish an anti-underwriter coalition. Then we get the word that frightens most buyers, conditions. When we get an approval, there are always going to be conditions, and conditions does not necessarily mean anything's wrong. A condition simply means the underwriter needs something before the approval is finalized or before closing. Maybe it's another document. Maybe it's an appraisal issue. Something needs to be fixed on an FHA. It needs chipping paint painted or something like that. Maybe it's title or insurance or something. They need a copy of the insurance policy. And by the way, Rich over at Valor can do any type of insurance you need anywhere in Pennsylvania, New Jersey, or Delaware. Maybe we change the agreement of sale. And here's where agents can actually cause problems without realizing it. If you negotiate a repair credit, change a seller concession, extend something, or modify the agreement, you've got to tell the lender right away. Don't create a beautiful little side agreement between the buyer and seller and surprise Caitlin 2 days before settlement, because a condition is basically a to-do item. A condition that nobody tells the lender becomes a closing delay, because there are laws in place that will delay closing automatically if we have a change that isn't built into it 3 days before settlement. Now we introduce the property itself. The appraisal gets ordered, somebody visits the property, value is reviewed, and depending on the loan program, there may also be property condition requirements. It's particularly important with FHA, VA, and USDA and renovation programs, which I'll talk about in a couple of minutes. As realtors, our responsibility here is pretty straightforward. Make the property accessible, make sure the utilities are on. This is often an argument. The appraisers want to see everything working. The utilities need to be on. If there are known repairs that may affect financing, let's figure out what those repairs are early so we can deal with them and figure out whether the buyer or seller is going to handle them. And if there's an appraisal gap, if it appraises for less than the sales price, we've got to develop a strategy. We do not form a circle in the office, hold hands, and conduct a ritual described on a slide as a group ritual, panic ritual, although I've witnessed variations of it. We've got to figure out whether or not we can get the seller to reduce the price to the appraised price, or we have to figure out if the buyer can come up with some additional funds in addition to the down payment they're already doing. And eventually we hear the three nicest words in mortgage lending, which is clear to close. That means underwriting is signed off on the required items. The buyer received the closing disclosure at least 72 hours before closing, showing the final loan terms and closing costs. And there are timing requirements, federally guided time requirements associated with that. And this is also where I would like realtors to resist the temptation to suddenly become creative. 3 days before closing is not the ideal time to say we decided to give the buyer another $7,000, or we changed who's paying for that. Or my personal favorite, it's really minor. We didn't think the lender needed to know. The lender needs to know. Near closing, boring is wonderful. No surprises, no unexplained changes, no drama. Just get everybody to settlement. I will throw something else in here that I don't have in the slides. One of the things I used to do consistently, and I think everybody should, when we got an approval, rather than having the lender call the client and say you're approved, which you can do, that's fine. Caitlin can call them up and say you got your final approval. Even though they know it's coming and they're going to get approved, they're sure it's not going to be a problem, it's always a sigh of relief. So what I used to do is I would get a coffee mug with Century 21 on it, put in some candy kisses, and get a couple of helium balloons saying congratulations, and I would go to their place of work. I'm not kidding. I want you to grow your business. I would go to their place of work with the balloons, with the little coffee mug with the candy kisses in. I'd walk in, people would think it's somebody's birthday or whatever, and you find them in their place of business, or you call them out to the front desk and you say, I just want to let you know your loan was formally approved. That is exciting. They introduced everybody in their company as the best real estate agent in the entire known universe and Canada. And they will talk you up everywhere because they're relieved and they associate that with you. So I do want you to consider that as a possibility when you're working with clients, because I want you then to be able to leverage every sale to get more sales out of it if possible. Then we finally arrive at closing. There's final verification. Again, they're going to run your credit the day before. The buyer signs what appears to be approximately the entire collected works of the entire Western civilization. Funds are transferred, the deed is recorded, and eventually somebody gets the keys. Our value as agents on closing day is mostly preparation. By that point, we're not supposed to be discovering things. We should already know how funds are being delivered, that the walkthrough happened, that insurance and title are ready, that everybody understands the process. The goal is that nobody announces at the closing table, oh, by the way, this is a problem. Those 4 words have ruined more lunches than I can count. Now, I will mention one thing. With pre-settlement walkthroughs, there are times, probably 15 times a year in our company, where you go to do the walkthrough and find that a pipe broke and there's water flooding somewhere, or some window is shattered, or something else. It happens. I suggest doing a walkthrough 3 days before the settlement and the morning of the settlement because you're likely to catch the problem 3 days before and negotiate it then rather than at the settlement table. So I just want you to be aware of that. So here's the realtor version of everything we just discussed. Get buyers pre-approved early, send the full contract immediately to the lender, coordinate the appraisal access if you have the listing, understand the concession limits, and that means each loan program allows the seller to contribute something towards the buyer's closing costs. Make sure you don't exceed that amount because you won't actually get it. And remember, when you're writing an offer and you're asking that seller to pay 2% of the buyer's closing costs or whatever that number is, you're reducing the seller's take, what they're getting. So they're going to consider it a lower offer. Keep repair language clear and warn buyers don't take on new debt. When you're writing the offer, tell them that. When they're applying for the mortgage, tell them that. And then track your dates. And again, loop in the lender early. That last one is the easiest thing on this entire slide. We have a lending partner available to us, user. I don't want Caitlin simply being the person you email when you need a pre-approval letter at 8:47 on Sunday night. She's a resource for helping us structure transactions. If you've got and by the way, she may not be able to structure it on the fly from the car while driving. Based on the customer's situation, because there's so many loan programs right now, she may have to look at it, go back to the underwriter, see what works best, and come back with a plan, with a solution. If you've got a strange borrower, an unusual property, a self-employed buyer, somebody short on cash, an investor, or a seller who thinks they're financially trapped, use her as a resource. And the mortgage should not be a mystery novel portion of our transaction. Now, seeing if you're paying attention, we've got a buyer under contract. They're self-employed. They received a $12,000 gift from a family member. They want a seller credit after the inspection, and we're closing in 25 days. What could possibly go wrong? Anybody want to throw anything in there? Lots of things, right? Self-employed income needs to be documented. The gift needs to be documented. If we are doing a seller credit, that needs lender approval. Even if we're saying, okay, the seller is going to pay to repair plumbing to the cost of $3,000, the lender has to actually approve that. And we've got a fairly tight timeline. So when should we bring in the mortgage lender? Then we should bring her in yesterday. That's really the lesson. Don't wait until you know there's a problem. When you see the ingredients that might cause a problem, get the lender involved. Notice I'm not asking you what mortgage product this buyer needs. That's not our job. I'm asking you to recognize that the transaction deserves the lender to talk. All right, enough of the mortgage process. I want to get into what I think is one of the most useful parts of today's program, some of the different loan programs and financing strategies that may help us solve real problems. And I want to emphasize something before we start. This is not a memorize exercise. I'm not going to call on somebody at the end and say, quick, explain the underwriting requirements for a DSCR loan for investors. What I want you to begin recognizing is situations, first-time buyers, veterans, people buying in the Poconos. The entire Pocono market is considered rural property. Self-employed borrowers, investors, and houses that need renovations. When you hear one of these things, I want your brain to start saying there may be a financing solution for that, but we better call our lender partner. And before I add her in a little bit, I want to explain why we're talking again about 21st century lending. They are one of our partner firms, like Mountain Abstract, like Settlement USA, like Valor Insurance. And Caitlin's somebody I want you to use as a resource. Not just, hey, Caitlin, please send me a pre-approval on Sunday night, but Caitlin, here's what I'm dealing with. Is there a financing strategy we should be looking at? And again, some of you are married to lenders. Some of you have lenders that you've dealt with for 27 and a half years. I'm not saying change that, but we do have this relationship in the company, and I would like it to use it when you can. She can help with pre-approvals, product comparisons, refinance analysis, rate conversions, and financing strategies for buyers, for sellers and homeowners and investors. When I say sellers, I want to point this out. One of the ways you're competing for a listing appointment, right? And they're interviewing 4 agents. And when you're going through your listing presentation, which I'm going to do next week again, we're going to do the listing presentation training again next week. And I'm going to update it a little bit because there's some strategies I'm building in that I think work a little bit better. But they're comparing 4 different realtors. And you want them tied to you. So when you're doing that presentation, one of the most powerful things you can do in the beginning is ask them a series of questions. Why is it important to you to move? What are you planning on doing? Has somebody taken the time to financially qualify you for this move? When you ask that question, has somebody taken the time to financially qualify you for this move? And they say no, but we did look online. You say it's helpful sometimes to know how much you can afford for the next property. Would it be okay if I had one of our lender partners connect with you and talk to you about what products might work best for you? Then we can figure out how to actually make this work. And that then you pass that over to Caitlin or Paul or whoever, and that person calls, and Caitlin says to your client, "Hey, I was asked to give you a call because you're thinking about moving and you want to know what you would financially qualify for if your house sold for 575,000. I can certainly do that. And by the way, you're working with Dwana. You are so lucky. She's one of the best. And that is giving third-party endorsement to you from somebody else. It helps to tie you to that listing. It's another way of trying to build your way in. So what you'll see in the next couple of slides are a lot of financing options out there that are for more than just the typical buyer, or more than many realtors realize anyway. So let's start with this. This slide looks a little intimidating because there are a lot of mortgage products on it. I have this as a flyer in many of the offices. Again, you don't have to memorize these. I don't want anybody leaving here thinking I have to become an expert on 14 mortgage programs before lunch. You need to know enough to recognize there's an opportunity. Think about it this way. If a buyer has very limited cash, there may be an option for them, like a USDA or a VA loan. If the buyer's a veteran, there may be an option. If the property is in a rural location, Nazareth, West Coastville, the Poconos, rural Bucks County, there may be an option. Self-employed buyers whose tax returns don't tell the whole story, there might be an option. Now, that usually has to go to an underwriter first to review. Investor buying based on rental income instead of their personal income. There is a program for that. A house that needs a lot of work and needs immediate renovations. We've got an option. Our job is to recognize the question. Our lender partner's job is to figure out the answer. So we're going to do a very quick tour of the toolbox. So, Caitlin, if I send you a buyer, do you generally want me, I'm going to tag her in here for a second. Do you generally want me suggesting a specific product, or would you rather I describe the client situation and let you figure out what product fits best?
I mean, obviously, you can always suggest what you think would work best for the client, but you also might not know what you don't know. So, really, the best way to do things is to actually describe the client's situation or have the client describe their situation so that we can come up with the best loan program that they might want. Because we have so many options with programs within programs, down payment assistance, all that stuff. So, it's best to describe the situation and we'll really work through stuff.
Nice. So I'm going to go through a couple of these from a high level, starting with the one everybody knows, conventional financing, which is what most loans have been over the last few years, but we're starting to see FHA and USDA coming back. This can often be a strong fit for buyers with solid credit and stable income and flexibility with their down payment. Now remember, conventional does not automatically mean you need a 20% down payment. That's one of those things consumers and occasionally some realtors for some reason still assume. Private mortgage insurance companies apply to properties where you're putting less than 20% down. But that's where Caitlin needs to compare the possibilities. And the lesson for us is don't just ask what's the rate. I hear that all the time. The rate is partly depending on their credit score. It's partly depending on how much they're putting down and the loan program they're using. So you've got to ask what combination of payment and cash flow and financing creates the strongest overall position for this buyer. Because sometimes keeping another $20,000 in the bank is more important than eliminating every dollar of mortgage insurance. Kate, is it fair to say that you frequently compare more than one conventional structure for the same buyer?
Yes,
Sorry,
because
good.
sorry, yes, because most of the time people are going to qualify for more than one structure. So we actually can play with a lot of different possibilities.
Nice. FHA is one that I want agents to remember, particularly first-time buyers, and buyers may need more flexibility in qualifying guidelines because the qualifying ratios are a little bit broader, and the way it looks at credit is a little bit easier in FHA than it is in conventional. It can expand your buyer pool, which means it matters to listing agents as much as buying agents. The caution is property condition. Now, everybody's heard horror stories about something 22 years ago where a loan fell apart because of the garage door not opening properly, or missing a handrail, or something with a roof. So if I'm listing a house that has some condition issues, I may need to understand that the type of financing might matter. But I don't want to automatically say this house won't go FHA. That's exactly the kind of statement I don't want us making unless somebody qualified has actually looked at the issue. So instead, let's ask Caitlin or Paul or our lending partner whether the condition creates a financing problem. Kate, as an example, what's one property condition issue you see agents worry about with FHA that is sometimes easier to solve than they might think?
I hear a lot about peeling paint, which is very different from stairs without railings, you know?
True, peeling paint is one of the things people panic over because you can't have peeling paint on a house that's selling FHA. But that doesn't mean somebody can't scrape the paint and paint it. If somebody wants the house and the loan program they qualify for is FHA, we have to try and help them to get in. VA loans can provide significant financing advantage for eligible veterans and service members. By the way, I'll tell you a quick story. You have to get a DD 214 to get a VA loan approved. And we did a loan. This is probably 15 years ago or more. Tim would tell me it's longer because everything seems closer today than it was. But it came up with the fact that he had another VA loan already. So he said, "No, I don't own another house." And they're saying, "No, no, there's another VA loan out there. You can't have two of them at the same time." And did more and more research. Turned out he was a truck driver. He married two different women in two different areas and had a VA loan on a house he had with wife number one and was trying to buy a house with wife number two. That did not go well for him, by the way. So here's something I want listing agents to remember. Don't be afraid of a VA buyer just because it's VA financing. A well-prepared VA buyer can be a very strong buyer. Eligibility has to be confirmed. Property and appraisal standards still matter. They will still look at condition. But we should be educating sellers, not apologizing for financing. If somebody served the country and has earned access to a financing benefit, I don't think our listing presentation should be, unfortunately, they're using VA. That's backward. The question is whether they're qualified and whether the financing works for this property. So you've got to judge the buyer by the strength of their file, not by mortgage folklore handed down from somebody who sold real estate in 1997, which includes me. This one is particularly important for us because of the markets we serve. This is called USDA, and it may be available for qualifying borrowers purchasing eligible rural properties, sometimes what consumers think of suburban. Local eligibility is property specific, so we've got to actually check our maps and all this other stuff to make sure we can do it. And the borrower has income limitations. You can't be earning $1 million a year and borrow USDA. So there are qualification requirements. But the nice thing about USDA is it's 100% financing. You can buy a property in Mount Pocono with zero down. Now you still have your closing costs, but the seller can pay up to 6% of the purchase price towards the buyer's seller closing costs. Now, again, that reduces the seller's net. But rolling those closing costs effectively into the mortgage gets a buyer into a house with no money out of pocket. And by the way, we can use this as something to talk about on a podcast. We can use it on a YouTube video. We can use it as a short reel on Facebook, or we can use it as an ad on Facebook and social media, talking about find out for me how you can buy a house with no money down in the Poconos, or find out for me how you can buy a house with no money down in northwestern Lehigh. You can say there may be USDA financing available for qualified buyers purchasing properties in this area. Let's have our lender verify whether this property could qualify. And suddenly financing becomes part of your listing strategy. And that's very different from sticking a sign in the yard waiting for Zillow to perform a miracle. This is also exactly the type of concept that you can turn into property-specific social content. So if you've got a seller who says, I'm willing to pay, instead of reducing the price, I'm willing to pay 5% of the purchase price in closing costs for a buyer. We turn around and turn that into a USDA ad. Buy this home, zero out of pocket. Make sense? Do you think that would attract attention? Buy this home, zero out of pocket. Very powerful tool that in the last downturn in the market, we used extensively and picked up so many buyers that we wouldn't have otherwise. At the other end of the spectrum, we have jumbo loans for higher priced properties where the loan amount falls outside the standard conforming limits. You've got to document, you've got to have some reserves, there's some credit requirements, they may be tighter. An appraisal and underwriting timeline deserves some attention because it takes a little longer to get a jumbo loan approved. But the important realtor lesson is affluent doesn't mean uncomplicated. A buyer can have a $2 million balance sheet and still give an underwriter heart palpitations. I was in Laguna Beach 2 days ago. We were talking to some agents there that had transitioned from selling, they're talking about $250,000 properties. They moved to Laguna Beach. They're selling properties, I wish I were kidding, for 40 and $50 million per house. Per house. And they say that buyers and sellers are exactly the same fears, same concerns, same marketing, same strategy, just much higher price points. And of course, you have to do a jumbo loan instead of an FHA. Now we get to the product that can actually help us market listings differently, 203K. If you haven't heard of this, this is called renovation financing, and it may allow a qualified buyer to finance both the purchase and the improvements, eligible improvements, together in one package. So instead of looking at an outdated property and saying nobody wants this because it needs 40,000 in work, we can start asking, could financing allow the buyer to purchase it and make the improvements? And that's a very different conversation. And this is particularly powerful on listings where the location, the lot, or the structure is great, but the kitchen apparently last met an interior designer during the Carter administration. There is more planning involved. Contractors and timelines matter. Not every repair fits every program. But instead of treating condition as an automatic deal killer, we can look for a financing path, FHA 203K. Kate, if an agent is taking a listing that obviously needs substantial renovation, would you rather hear about that property before it hits the market?
Obviously, before, I mean, these are going to be one of your more time consuming ones because we have to identify what the type of renovation is, the size, scope, and the price, the credit guidelines. Like, we have a lot to cover in order to actually go through with these renovation loans. So, the earlier we get it done, the better it is because no one wants to wait around and sit and hope.
But keep in mind, guys, if we've got either a house that is struggling to sell because of the condition, or a buyer who can't afford a house that's pristine, but might be able to afford a little bit more of a payment so we can build in some renovations, this is the type of loan that makes that kind of transaction happen. And if you do two of these a year and we add two transactions to your bottom line, you've made an extra 10 or $12,000 that year. Adjustable rate mortgages are another tool. And notice the word tool. They're not automatically good. They're not automatically bad. They're appropriate for certain borrowers, for time horizons, and for financial situations. They may offer a lower initial rate or a payment in some situations that's lower, but the buyer has to understand how and when that rate can adjust. Some of them adjust each year. Some of them adjust after the fifth year. There's something that adjusts after the seventh year, 723. So I love the line in this slide. An arm isn't a magic trick. It's more like a power tool with instructions. You probably shouldn't operate either one if you haven't read them. Kate, can you give me a 30-second version? What type of buyer might at least be worth having a conversation about an arm with?
Because arms are adjustable, most of the time the people who are going for these ones are people who don't plan to be in one place for too long. So like if they have a 3-year contract with a job and they know they're going to sell the house and move on again, that would be great because obviously the interest rate is much lower at the beginning than it is at the end. So if you sell it before the higher payment, cool. But they're also good for people who are, about to expect an income increase too, so that they get that initial lower payment that meets where they are now and then raises to where they're going to be in a few years.
What you talked about income raising over time, one of the types of jobs that does that, if you're a physician, for example, and by the way, she has some specific physician programs as well that might work better, but a physician might be working as a resident. They're working whatever that number is, $40,000 for that year, and they're guaranteed a loan. They're guaranteed an income of 200,000 next year. That's a person who wants to buy a house might be able to get away with an arm now, figuring they're going to be paying later. And the other thing is they could always possibly refinance in the future, hoping rates don't get any higher. 15-year loan, I'm just going to mention, is less about can I buy the house and more about financing strategy. You're generally going to have a higher monthly payment, but you're building equity faster and paying less total interest over time. And that can be particularly interesting for somebody who's 60 and downsizing. Imagine telling somebody sells a $700,000 house with some substantial equity and buys something for 450. They may not be looking for the absolute lowest monthly payment. They might be saying, I'd like this paid off before I die. And that's a different objective, which means possibly a different loan structure. Again, listen for the client's goal first. This is a mortgage everybody recognizes, a 30-year fixed rate mortgage. It's predictable. Payments, generally lower payments than a short amortization. It gives some flexibility. So I'm not going to spend a lot of time on this. Reverse mortgage, I'll just throw out there. It's one I don't need you to become an expert on. I just want you to know it exists. When homeowners are 62 or older, a reverse mortgage may allow some people to access home equity while staying in their home. It does require careful explanation and counseling. It's obviously not right for everybody. As realtors, we're not going to deal with this quite as much because we're hopefully selling that property. And this slide may be the most important one of the product section because these are exactly the borrowers who often assume they can't get financed. First is what we call bank statement loans. Think self-employed borrowers. They may have a strong business and substantial deposits, but their W-2 or their traditional tax return picture doesn't fit neatly into a standard box. I'm not saying they qualify. I'm saying don't eliminate them before Caitlin looks at them. The second is what's called a debt service coverage loan, a DSCR loan. That's for investors. Instead of the conversation being driven by the buyer's personal income, there are certain investor programs that may look at the income generated by the property instead of their income. Again, this is not your job to calculate it. Your job is to recognize this as an investor scenario and let them know we can do DSCR loans because a lot of investors get really excited about that. Third is down payment assistance. Maybe the borrower can comfortably handle the monthly payment, but the obstacle is cash to close. It's a very different problem from somebody who fundamentally can't afford the house. And fourth are fix and flip and investor programs. These buyers may need specialized financing based on acquisition, renovation, and exit strategy. And that's why I keep telling you, call your lending partner before you tell the client no. Because specialty products are exactly where early lender involvement can change the entire real estate strategy. And maybe I'll hand Caitlin one final question. That's a quick product tour. You're officially qualified to do exactly what you're qualified to do 10 minutes ago. Call Caitlin. The difference is now knowing why to call her. Actually, I didn't ask her a question anyway. All right. Okay, so we're going to put you to work for just a second. I'm going to give you 6 people. I don't want you to necessarily tell us which mortgage you're getting. Instead, tell us what you would want to know before you started recommending anything. First-time buyer, limited cash, decent credit. What are the first couple of questions you might ask? Actually, because of time, I'm not going to ask I was going to ask the audience this question, everybody who's participating, but I want you to think about these. Veteran buyer wants to minimize cash to close. Self-employment buyer has strong deposits, but the tax returns are complicated. Investors buying a rental property, and fixer-upper buyers that can afford the house, but the house looks like Property Brothers arrived and quit halfway through. And finally, a downsizing senior, lots of equity, but they're very payment sensitive. The point I want agents to hear is the borrower doesn't walk through the door labeled FHA buyer or a DSCR buyer. They walk through with a situation. Our job is to recognize enough of the situation to get the lender involved, and then she figures out the financing path. Now, I want to get to this section I want you to pay attention to as realtors. Everything we talked about so far has been helping a buyer get financed. I want to change the question a little bit. How can financing help us market and sell real estate? Because that's where knowing this stuff starts producing listings and buyers and transactions. And this is how we can expand our buyer pool and solve objections and make listings easier to understand. And keep in mind, our in-house lenders are going to be working to generate buyers and pass them back to realtors. Realtors are working to generate buyers and pass them to our lending partners. So hopefully this rising tide will lift all boats. Now, one of the biggest mistakes realtors make is thinking financing starts after somebody decides to buy the house. Financing can actually help them decide that the house is possible. The property hasn't changed, same kitchen, same roof, same taxes, same neighbor who apparently owns 17 wind chimes. What changes is the buyer's understanding of how they might be able to buy it. That can mean more buyers seeing a path. The seller hears a better marketing story. The listing becomes more actionable. That's marketing. And I'd argue it's considerably more useful marketing than writing another paragraph about cozy charm and memories waiting to be made. So let's take a look at a few ways we can actually use financing in our marketing. The first one is payment-based marketing. Most consumers don't really shop based on purchase price. They think about monthly payments. So rather than marketing only $399.9, we may be able to work with Caitlin and Paul and the team and show buyers different financing payment possibilities. We used to do during the last trough, we would run our ads where we didn't have the price on the listing. This was in Homes magazines, which don't exist anymore. Instead, we'd have a little banner that said how much it cost per month. And that caused a lot of calls to come in saying, I can own this for $1,750 a month. Yeah, you can. Maybe there's a lower down payment scenario for the listing. Maybe there's a stronger down payment scenario. Maybe there's a renovation financing we can apply to a particular property. Maybe there's an investor program. Maybe there's a strategy that addresses the rate. The important part is we don't want to invent the numbers ourselves. If we're going to advertise payment scenarios or rates or cash to close or anything similar, have Kate support the assumptions to make sure our language is appropriate. A much safer phrase is ask about financing options that may help qualified buyers purchase this home with less cash down, renovation funds, or a payment strategy that fits their goal. Possibility, not promises. That's also much more compelling than price to sell, which apparently every house has had in their advertisement since probably 1978. This is the beginning of something we're going to come back to in more detail in a couple of minutes. One of the biggest obstacles in our market right now are what I called seller locks. Why would I ever give up my 2.87% mortgage? And that's a legitimate question, and we should not dismiss it. But the mortgage rate is only one piece of their financial picture. They probably, because most people do, have credit cards at 20 or 24%. They may have a car payment. They may have a student debt or personal loans or a HELOC. So instead of asking, what's your mortgage rate? The better question might be, what does your entire household debt picture look like? And by the way, one of the things I got out of the Tom Ferry event in the last couple of days is that a lot of the top agents are using this to retool sellers and show them how they're actually going to be able to buy something for around the same cost as what they're selling if they roll some of these high interest debts back into the loan because it's a blended rate. As somebody who's got substantial equity may have more flexibility than they realize. And again, this is where we bring Kate in, not to talk to them about moving, but to actually run the numbers. And we're going to spend more time on this later because, again, I think this is going to be a very valuable listing tool shortly. But here's the basic example. Let's say you own a house or they own a house that's got worth about $385. They bought it in 2017. It's worth $385 today. They still owe about $200,000 because they paid $225 for it back in 2017. So they've got roughly $185,000 in gross equity before commission and transfer tax. After illustrative selling and moving costs, we've got about $154,000 left before other debts. Now, suppose they also have $75,000 down here in credit card, auto, student, or revolving debt, and that is not uncommon these days. If they use part of the equity to eliminate that debt, they'd still have $79,000 available toward the next home purchase. And let's say they're looking to buy a house for 5.25, trading out one for 385, buying one for 5.25. And this is just an illustration. Now, here's the important idea. They may think they're trading a 3% mortgage for a 6.5% mortgage, but financially, they may actually be exchanging a whole collection of debts at 3%, 8%, 10%, 24%, or higher for a cleaner overall structure. We're not saying it's automatically better. We're saying it's worth calculating because the blended rate on what they owe between that $75,000 credit card and the $200,000 they owe in the mortgage may actually be closer to 8% total blended rate. They may actually be saving money. And that's a conversation that can get somebody off the fence because rates aren't bad. Don't ever say that they are good or bad. This is the concept on one slide. Mortgage rate is 3%. Credit cards might be at 24%. Auto at 10%. Student or revolving debt is typically at 8% right now. And when you weigh all that together, the household's effective debt is about 6.3%. Now we're comparing that with the new mortgage example of 6.5. That doesn't mean all payments are identical. Doesn't mean everybody should move. It doesn't mean that 6.5% suddenly becomes an exciting interest rate. It just means stop comparing one rate with one rate. Look at their whole balance sheet. That's a much more intelligent financial conversation. Nobody's ever looked at 6.5% mortgage and whispered, how romantic. We're simply putting it into perspective. That's what we're trying to do. Now let's take a look, take financing and apply it to a difficult listing. Suppose you've got a house that needs work. Traditional marketing strategy is to run an ad that says needs TLC, which buyers have learned means bring lots of money, contractors, and perhaps a structural engineer. But renovation financing may let qualified buyers finance the purchase along with eligible improvements. Now we're repositioning that property. So instead of this kitchen is terrible, we're saying there may be financing options that allow you to purchase the home and finance eligible improvements. It's a much better story. Now, don't oversell it. Don't promise what will qualify. And please don't develop a $150,000 imagery renovation plan on Canva and tell the buyer that their lender is going to finance it. Call Caitlin first. Another huge opportunity. First time buyers. Some of you specialize just in first time buyers. By the way, we used to run this ad using the USDA program and one of the FHA programs where you could get into a house with less than $2,000 out of pocket. And we'd run an ad in the for rent section of some of the online ads. Morning Call had one, classified ads. I can't think of what the classified ads are that we used heavily, but we would run rent, lease, purchase, or buy, uh, $1,500, $1,700 a month. And we'd get 100 calls because people wanted to rent it. And then we'd ask them, would you rather rent or would you rather own? And they'd say, well, we'd love to own, but we can't because we only can pay the $1,700 a month. Well, no problem. Can you come up with first and last month's rent and the security deposit? You'll need about 6 grand. Yes, we can come up with that. If we could get you approved for a loan and you only had to come up with $5,500 out of pocket and a payment of $1,750 a month, would you buy a house? Would you buy a house like this? Well, sure, but how can you do that? We've got a special loan program that'll do it. Now, it's actually an FHA product. We have to find a property that will allow us to have the seller pay the buyer's closing costs, but it gets them into the house. So that netted us. We had an agent who did that exclusively, that was selling 55 to 60 homes a year just using that technique. So many buyers think they need 20% down and perfect credit. Now, by the way, when we'd run this and we get 100 people who wanted to rent, about 20 of them would let us run their credit. About 8 of them would actually qualify to buy a house. Here's the funny thing. 7 out of 8 of those people never knew they could buy a house and they bought one. It led to a lot of sales. So marketing can focus on the possibility. Low down payment options, FHA, some of the conventional 1% down, 3% down, down payment assistance programs where it's appropriate, and give them a simple call to action. Everything should end with a call to action. Could you buy a home sooner than you think? Or you're at an open house. Instead of immediately asking, are you pre-approved? Try asking, would it help if we had our lender, Kate, show you a couple of financing possibilities before you assume this is out of reach? It's a very different conversation. And we've already created social media around this exact idea. Financing gives us content, not just loan applications. And I will point out that some of our coordinators are spectacular at this. Ray has done some great ads for us. Laura has been doing, if you haven't seen some of the stuff at Central and Country Lake Homes Facebook page, you should check out some of the stuff Laura's been putting together. It's fantastic. And our entire team, Loren, Gail, all of them are great. Mary, all of them are great at putting stuff together. But tap into some of the resources we have. Could you buy a home sooner than you think? Talk with, and I changed this to your name, about your first step toward home ownership. But put something together and get it out there if you're going to target first-time buyers. This is another one that's particularly relevant for a lot of our markets. That USDA eligibility becomes a genuine marketing advantage. Certain qualifying borrowers purchasing eligible properties may have access to zero down programs. And again, eligibility depends on both where the property is, how big the property is, and the borrower. They can't earn too much, but it's a pretty high bar. I think it's like 600 and some thousand. So we're not advertising guarantees. But imagine you're competing for a listing in one of these communities. Another realtor says, I put it on the MLS and Zillow and Realtor.com. You're going to say, we're also going to explore whether this property could be marketed to buyers using USDA or other specialized financing. And we're going to work with our lending partner to help those prospects understand the opportunity. And that's how we sell more of our listings. Now you're actually bringing a strategy to that listing presentation. And that's the difference between marketing the house and simply advertising the house. And here's an example. And I did these in about 3 minutes. So here's another example. Could this home qualify for 100% financing? Rural buyers may qualify for USDA or special financing options. Talk with, and I may put in here, Dwana, talk with Holly, talk with Tim about homes that may qualify. And of course, change it to Central and Country Lake, Central and Keim, Central and Emerald. But this is something that one of our coordinators can help you put together. This is something where I can help you put it together, but there's lots of possibilities out there. Investors are another completely different audience. Let's say we're targeting investors. They're not primarily asking whether they love the breakfast nook. They're asking what's the rent, what's the expenses, what's the net operating income, the NOI, how fast can I close, what documentation do I need, and what's my exit strategy. And that financing is called DSCR, debt service coverage ratio loans, or bank statement programs, or in some cases, fix and flip financing or other investor products. So if I'm marketing an investment property, I want clean rent information, not something on a napkin. I want clean expense information. I'm going to have to get from that owner the last 3 years statement on their tax return of how much income came in. And I need copies of the leases. I need enough financing language to attract buyers who understand what they're looking at. Something like ask about investor loan options that may use property income, renovation strategy, or alternate documentation. Again, we're not promising anything. It's opening a door. And investors generally like doors, particularly if those doors produce cash flow. And again, I created a quick ad for this. Investor loan options can open doors. And we can put something like this together. Or learn how you can buy a property using only the income from the property. Something like that. We can put something together that's going to attract them. Again, put your name in here, and we're going to put an ad along with it. And you're going to share this stuff on social media anywhere you can. I would do shorts on Instagram Reels on this. There's an agent in Easton right now that's been doing little ads on these on Instagram. They're probably 30 seconds long. He's doing one every couple of days. And he just said that he sold 7 properties this month. How many of you would like to sell 7 properties this month? And he's doing it based on these reels that he's posting that people are following. This slide might be worth taking a quick picture of too, because these are the phrases you can actually use. For that rate lock seller, that person who's stuck with that 3% loan and does not want to have a 6.5% loan. Before we decide you're stuck, let's compare your whole debt picture with Caitlin. Notice we're not arguing with him. For the buyer who's worried about the payment, let's price the monthly reality, not just the headline interest rate. For the fixer-upper, there may be renovation financing options that let a qualified buyer finance improvements. And maybe the most important one on this slide is the last one. I don't want to guess. Let's get the lender involved before we roll this out. These are things you can say to a buyer. That last sentence will make you sound smarter than trying to answer a mortgage question that you really don't know. There's absolutely nothing wrong, by the way, with telling a client, I don't know, but I know somebody who does. Even the lender, if Caitlin or Paul is thrown a scenario where they're self-employed, or we just had one that was really interesting, where the person worked for a union, and every week they sent him to a different job somewhere else, and his salary, his income, changed based on the job he was doing. That's pretty hard to do. So we have to go back to the underwriter and say, how do we position this? It's not something anybody knows off the top of their head. I don't know, but I know somebody who does. In fact, that's what professionals do. We don't need to know everything. We need to know enough to recognize the issue and have some really good people around us who know the rest. And for mortgage lending, that's why I want you to call our team. Now, I'm going to spend just a couple of minutes on that one seller conversation I was talking about, because I think this one can help us to create some listings. So before we start doing math, one quick reminder, we're realtors, not lenders. We're not quoting rates as guarantees. We're not promising approvals. We're not telling somebody exactly what their payment will be. We're certainly not giving tax or credit repair advice, because apparently we don't have enough liability already in our business. Our job is to identify an opportunity. And when the numbers start becoming borrower specific, our safest and smartest sentence is, let's have Kate run the numbers, or whoever your lending partner is. That's not passing the buck. That's being professional. That's more sophisticated. That's a more sophisticated you as an agent. The more comfortable you should be saying, I know enough to know when an expert should be involved. And with those guardrails in place, let's talk about this big seller objection that we keep running into over and over and over again. It's the most important seller conversation we're having today. We have millions of homeowners looking at their existing mortgage, maybe 3%, maybe lower, and saying there's absolutely no way I'm going to give up this 3% loan for a 6.5% mortgage. And I understand that. And our response should not be rates aren't all that bad. I remember when they were 15%, because I do. That's not what we should say. Because compared with 3%, 6.5% is terrible. So instead, the conversation should be, let's look at your whole balance sheet before deciding you're trapped. Because we're not trying to convince somebody that 6.5% is wonderful. We're trying to determine whether their 3% mortgage is actually telling the entire financial story. And by the way, one of the things that happened at this event over the last couple of days is that people were saying, well, what happens when it comes down to five? We don't know that it ever will. The average rate over the last 40 years has been 8.5. The average rate over the last 40 years has been 8.5. We hope that the rate's going to come down into the fives next year. I don't think it's going to happen in 2026, but we don't know that. What the experts on the panel said yesterday or 2 days ago was they expected to stay in the sixes for the next 2 years. Do you want buyers waiting 2 or 3 years to buy while they're blowing money on other stuff? So when a seller says, I'm not giving up the 3% mortgage, don't argue with them. I'd say you may be absolutely right, but let's not guess. That immediately lowers the temperature. And then say, before you make the decision, let's compare what you're paying on all of your debt today and what a new structure might look like. Because their mortgage has one interest rate and their household debt may have a completely different blended rate. And that's the reframe. We're not dismissing the objection, we're making the objection financially complete. This is the mistake everybody makes. They see 3% versus 6.5, and 6.5 looks bad. If those are the only two numbers we're looking at, the conversation's over. But suppose that 3% mortgage is sitting next to a credit card debt at 22% and a car loan at 11%, maybe some other revolving debt. Now we don't really have a 3% household debt structure anymore. In the example we're going to work through real quick, the weighted average cost of the current debt was 5.9%. So we're not comparing 3 with 6.5. We're comparing the cost of the seller's entire existing debt structure, or what the household financing might look like after the move. That doesn't guarantee moving makes sense to them, but it simply makes the comparison honest. 3% is a beautiful mortgage rate. 22% credit card debt is where that beauty starts to fade. So rather than asking only what's your mortgage rate, I want you asking three broader questions. First is, how much equity do you have? Because equity creates choices, and because property values are double what they were 6 years ago. So a lot of people have equity, a lot more equity than they've had in forever. And the second question is, what other debts are eating up your monthly cash flow? Let me say that again. What other debts are eating up your monthly cash flow? Credit cards, car loans, student loans, personal loans, HELOCs, buy now, pay later accounts, all the little financial barnacles that accumulate over time. And third, could moving actually improve the whole picture? Maybe the answer is no, but maybe selling unlocks enough equity to eliminate high interest debt, provide a down payment, and create a cleaner household balance sheet. And that's what we want our lending partner to analyze. And they can't do it instantly over the phone. They're going to have to work this out on a spreadsheet. But we're not selling the house because mortgage rates are fun. Mortgage rates are about as fun as a dentist appointment. You just hope the outcome improves your life. So putting in some real numbers. We're going to deliberately use these simple numbers so clients can understand this without needing a financial calculator or an emotional support spreadsheet. Currently, the house is $385,000. That's what it's worth. They have a mortgage balance of $200,000 at 3% because they bought it for 2.25 back in 2017 or 2018. So if they bought it back then, by the way, it's probably worth $400,000. They might have $30,000 in credit cards. That's common at 22%. Another loan at 11% for $20,000. Maybe that's a car loan. Maybe it's student debt. They'd like to move up to a nicer house at 5.25, but the rate's going to be 6.5 as our new illustrative example. Now remember, this is training math. We're not quoting anybody an actual loan. We're not including taxes, insurance, PMI, or closing costs right now. We're simply trying to answer one question. Is the homeowner really as financially trapped as they think they are? So the first thing we've got to determine is what equity actually looks like. So if a house sells for $385,000, we pay off a $200,000 mortgage, and we have maybe $26,950 in selling costs. That leaves us about $158,000 net equity. And that's an important number because sellers frequently know they have equity, but they haven't really thought about what that equity could do. It isn't simply money they roll blindly in the next house. It's capital, and that capital might be used to pay off some of the debt. It might become a down payment. It might provide reserves. It might create options for them. And as the slide says, keep these estimates conservative. If your projected net sheet looks like it was prepared by a carnival barker, the client's eventually going to notice. Now look what's actually happening here. They've got $200,000 mortgage at 3%, $30,000 at 22%, and $20,000 at 11%. If we weigh those rates according to the balances, the household's approximate blended rate on $250,000 in debt is actually 5.9%. And that's the light bulb moment. The homeowner keeps saying, I've got a 3% rate. Yes, yes, you do on your mortgage, but that's only one part of your debt. You've also got 50,000 sitting at higher rates. So the financial conversation isn't really 3% versus 6.5. It's closer to what happens if we restructure the debt portfolio that's already costing you 5.9% on a blended basis. That's a different question. And I'd immediately remind them this is exactly where I want Kate doing the borrower specific calculation, not a calculator on the kitchen table for you. Interest rates are important, but people don't actually write a check every month for an interest rate. They write checks for payments. In our example, the current 3% mortgage principal interest for that $200,000 loan is $843 a month, not counting the taxes and insurance. If we illustrate a $30,000 credit card balance as a 5-year payoff, that's another $829 a month. Another $20,000 loan using a 5-year payoff is about $435. So the current debt is $2,100 a month, $2,107. So when my seller says my mortgage payment's only $843, that's true. But their household debt burden in an example like this is over $2,100 a month. And that's the number I want to use to compare. And let's make a disclaimer here. These are illustrative payments, taxes, insurance, HOA fees, PMI, and the actual debt terms all may need to be calculated and included when Kate runs an actual analysis. But let's use this equity intentionally. We had $158,050 left from the sale. That's up here in the left-hand corner. But we pay off 30,000 credit card, 20,000 other loans. We're left with 108 grand. They're buying a property for 525. We're going to take that 108.50, and that means we're going to borrow new 416,950. Now, this is the house they wanted to be in. They've hoped to be in for the last 5 years, but couldn't leave that 3% loan, right? Now let's notice what happened. The new mortgage is certainly larger. The old one's 200,000. The new mortgage is 417 almost. But the credit card balance is gone. The other loan is gone. And instead of carrying all this debt into the next house, we've used equity to restructure the household finances. Again, this does not automatically make this a good decision, but it gives Kate something meaningful to compare. And this is really the money slide. If they stay where they are and keep the existing debts, in our illustrative example, they're paying $2,107 a month. If they buy that house for 5.25 and somehow drag all their existing consumer debt with them, about $35.83 a month, that's painful. But if they use the equity to eliminate the higher rate debt and finance the new house, their payment, I'm not sure where I got this from. I'm missing one. Here we go. Oh, 2635. This is if they kept their debt and bought the new home, they'd be paying $3,600 a month. If they paid off their debt and just had a mortgage going forward, instead of paying $2,100 a month and keeping their debts in their current house, they're now paying $2,600. It's still $500 more a month, but their debts are paid off. So instead of the move costing them $1,500 more a month, this difference keeps them about $500 a month more. Think about what they've accomplished though with that difference. They went from a $385,000 house to a 5.25 house. They eliminated $50,000 in debt. And that doesn't mean the move is right for them, but it's a completely different conversation from going from 3.5 to 6.5. I can't possibly move. And compared with buying the next house while keeping the consumer debt, restructuring, saves them almost $947 a month. So that's the point. Don't argue the rate, change the comparison. And before anybody uses these figures with an actual client, Kate needs to run a real scenario, including taxes, insurance, and PMI and everything else, and the actual loan terms. So kind of finishing up, this is where we translate all that math into something a normal human being would actually say. The bad version is rates aren't that bad. A lot of people are saying that. Oh, we used to pay this. Please don't say that. Somebody with a 3% mortgage, you sound ridiculous. You're basically trying to win an argument with their emotions. Instead, you might try saying you may be absolutely right to protect that 3% rate, but before you make that final decision, let's let our lending partner compare your whole debt picture, your mortgage, your credit cards, your car loans, and everything else, with what a payment on the next home might actually look like. And notice what we've done. We've agreed with them. We didn't pressure them. We didn't make any promises. We just asked permission to look at the math. And then ask one more question. What would need to be financially true for moving to make sense for you, or true financially for it to make sense? And that's a phenomenal question. They may say my total payments can't go up more than $500 a month. Great. Now we've got a target. Maybe they say I need to eliminate those credit cards. Great. Maybe I need 25,000 left in the bank after closing for emergencies. No problem. Now, instead of debating interest rates, we're designing around a client's actual goals. And I like to finish this slide with, and that's the role I want us playing, curiosity, not pressure. We're not trying to talk people into selling. We're trying to keep them from talking themselves out of selling based on one number because it doesn't tell you the whole story. Uh, Now, this is the handoff I want you to remember when you have one of these rate lock sellers. You don't need to figure out whether they should move. Give Kate or your lending partner enough information to answer 5 questions. What does the next house look like if they keep all their existing debt? Number 2, what does it look like if we use some of the sales proceeds to eliminate some of that expensive debt first? Number 3, does paying off that debt improve their debt to income ratio enough to actually change their borrowing position? Number 4, are we going to have mortgage insurance? And if so, how does that affect the comparison? And finally, how much cash should they keep after closing? Because I absolutely do not want someone to use every nickel they have to buy the new house and then discover on Tuesday that the furnace just joined a monastery. There should be reserves. And those 5 questions turn this from a real estate sales pitch into an actual financial comparison. Because we are here to help people make good decisions, aren't we? And that's where we work together with our lending partner to make that happen. There's an important caution here, though. Just because we can restructure somebody's debt doesn't mean we should. This strategy only makes sense when it genuinely improves the client's position. Because again, we're here to help them make good decisions. And a good candidate might have meaningful equity, expensive consumer debt, and a legitimate reason or desire to move. They're having twins. And enough financial discipline that paying off the credit cards doesn't simply create room to fill them back up again. Because if somebody pays off $30,000 in credit card debt on Monday and starts rebuilding it on Wednesday, we haven't created a financial strategy, we've created a sequel. And these are things that Kate has to test carefully. PMI could affect payment, the mortgage insurance if you're putting less than 20% down. Taxes on and insurance on a new house might be higher than the one on the current house. Stretching short-term consumer debt into a 30-year mortgage could increase the total interest paid over time. And we absolutely need adequate cash reserves after closing. And there are situations where this simply isn't a good idea. If they don't really need or want to move, don't manufacture a reason. If a new payment creates significant payment shock, don't force the math. If they're going to be left with virtually no cash, that's another warning sign. The goal is not to get the listing at all costs. The goal is to help the homeowner discover whether a move actually improves their situation. And by the way, once you help one person do this, they tell their friends, don't they? Where does most of our business come from? In this company, 67% of our business last year came from people referring us. Past clients, our social network, our sphere of influence, and people being referred to us from those groups. So if they are out positively talking about us, helping them to get into another property because of what we were able to do financially, it gives us more people coming to us. And again, we don't want to become financial confetti cannons. We want to help people any way we can. All right, I think I've covered this part enough. So the takeaway, the entire 3% rate trap, we've got to boil down to this. A seller can be emotionally rate locked without actually being financially rate locked. Their 3% mortgage might be terrific, but if they're carrying expensive debt alongside it, their overall financial picture may look very different. So using equity to eliminate expensive debt and restructuring everything into a new mortgage may or may not improve the household finances. Our job isn't to decide that. Our job is simply to say, before you assume you can't move, let's look at the whole picture. And then let's calculate the numbers. Let Kate or her team help the client to decide what might work. All right, so let's turn all of this into a habit. What I don't want is client finds house, client falls in love, client writes offer, agent calls Kate at 9:42 at night and says, can you qualify him quick? We need a lender. That's backwards. The financing conversation should start in the beginning. A lead comes in, we make the lender introduction, we get that buyer pre-approved before they start shopping, if humanly possible. You might meet them at one house, but then get them pre-approved. And then we match the property and the financing strategy. When we're writing an offer, Kate can help us understand whether there are financing considerations that strengthen our offer or complicate the offer. And once we're under contract, we keep that communication flowing through underwriting and through closing. And this doesn't just apply to buyers. At open houses, use our lending partners as follow-up resources. At listing appointments, particularly with move-up sellers, ask that financing question. Has anybody taken the time to financially qualify you for your next move? And after closing, there may eventually be refinance or equity opportunities as well. That's where you reach out because you've become the hero helping them get that refinance done. So our lending partner shouldn't just appear at the end of the process. She should be part of the strategy near the beginning. And again, I would run through these. Listing A might have an outdated house with good bones, so we might need renovation financing. Listing B might be a rural property or even suburban in the Poconos where buyers keep saying it's just beyond what they can afford. Maybe we can talk about a USDA conversation, verify their eligibility. Buyer C might be self-employed with strong deposits but complicated tax returns. So we're going to look for an alternate documentation type loan. And seller D, 3% mortgage and a pile of high interest revolving debt. Hopefully everybody can answer this one by now. And I don't want to be one of those training sessions where everybody says that was interesting, closes the PowerPoint, and resumes doing exactly what they were doing yesterday. So here's my 30-day challenge. Over the next week, add a financing question to every serious buyer and seller conversation, not an interrogation. Just make sure every time you talk to a buyer, ask them enough to determine whether financing might be affecting their decision. Week 2, I want you to look at your listings and ask, could financing change how I'm marketing this property? A renovation loan, a USDA loan, first time buyer opportunity, investor financing. By week 3, I want you to create one piece of marketing with mortgages included in it, a social post, a handout for open houses, a financing call out on a listing. We've already shown you several examples of what something can look like. And then by week 4, take your stuck clients to cater to your lending partner or to Paul. Buyers who think they can't qualify, sellers who don't think they can afford to move, self-employed buyers who assume traditional financing are not going to work, investors looking for another structure. Have her look at them. One small habit can make an enormous difference. That extra sale or 2 or 3 a year makes a big difference in your net income. And ask financing questions before your client talks themselves out of doing something. And remember, if you get them in front of a lender who likes you, have them call Kate. She's going to turn around and say, "Oh, you were referred to me by, Duana. You were referred to me by Tim. You are so lucky to be working with Tim. He's one of the best in the industry." And you get that third party endorsement from the lending partner. I want you to think about your business right now. Who do you have who's stuck? Maybe it's a buyer who doesn't have much cash. Maybe it's somebody self-employed. Maybe you've got a listing that needs work. Maybe there's a rural property that's not moving. Maybe you've got an investor who keeps running into financing problems, or maybe, and I suspect several of us have this, it's the homeowner who says, "I'd love to move, but I'm never giving up my 3% mortgage." So give us that situation. Don't just give private financial information or anybody's name. Give us the scenario and let's talk through what questions we should be asking. That's all I've got at the moment. Kate, do you have anything you want to add before, since I kind of talked monotonously for the last hour and a half?
No, I think you pretty much covered everything. I think the major takeaway is talk to the lender, talk to me or Paul or anybody, because I think one of the big problems people run into is that they either automatically assume they know all the loan products, which are constantly changing, and all the features are constantly changing. We do brokered and correspondent loans, so we actually partner with lenders that change all the time. Like we just partnered with Cake TPO, which is the creme de la creme of DSCR loans. And, we offer non-traditional mortgage products that change all the time. So don't automatically assume you know the products, and don't automatically box out a client that you don't think will qualify, because we actually, for example, we had one that was a buyer from a different real estate firm that was automatically boxed out because they thought they couldn't do a trailer loan, but we can do that. So just talk to us, just ask questions, and we'll figure it out.
By the way, what you hear in the background is a leash. When she shows up to do a pre-qualification, she brings her tiny little dog with her, which clients seem to love. So I'm just pointing that out. Does anybody have any last minute questions? I know I ran long here today and I did cover probably too much, but I wanted to make sure that we covered everything you could need for mortgages and at least give you that, 30,000 foot view. So any questions at all?
The contact we have right now on the screen for Caitlin, is that the correct one to use?
Yes. Actually, if you call 610-835-LOAN,
Uh,
that's the Pennsylvania office that will get you to Caitlin or Paul or
uh,
Ricardo, any of the lending partners here. The text number is her direct line. So you can
uh.
text her directly, and her email is there as well. Yep.
And also, is it okay for us to, let's say, refer to just one lender, or do we have to give them like a list of, give them options? I just don't know what's, I'm new, so
That
I have
gets,
no idea what's
so that
legal.
gets interesting. I have to be careful because I'm recording this. Technically, you're supposed to give anybody options on anything. So if you have a home inspector, you're supposed to give them 3 to 5 home inspectors to choose one.
Mhm.
We know that the buyer is always going to say, well, which one would you choose? And it gets
Mm-hmm.
really hard sometimes to say that. One of the nice things about, let's say, when we use, as an example, Rich for insurance, he has 100 different companies he can write through, including 7 of the top 10 in the country. So he runs and this is for insurance, but just to give you an idea.
Mm-hmm.
So when you refer somebody to Paul for insurance, he runs all the top companies, and Travelers might be better than State Farm, as an example, but he can write both, or Farmers, or whatever.
Hmm.
So he can find the best rate. So you are kind of giving him an option of a lot of things.
Okay.
With
Noted.
Caitlin, she actually can write through a lot of companies. 21st Century Lending. For those of you who don't know, a lot of companies will tell you they write directly through United Wholesale. United Wholesale, by the way, is the largest secondary lender in the country. They're enormous. The largest lending partner of United Wholesale is 21st Century Lending. So they have a fantastic relationship with them. Some of the training is done directly at United Wholesale's office, but Kate can actually write through a variety of other lenders as well. So she's got a lot of programs she can do that's outside. So typically, we tell people we're going to give you several lenders
Hmm.
uh, to shop, but the reality is this is somebody we at least want to get you pre-qualified. So I talked to this person first.
Oh, thank you. Thank you. Just wanted to make sure.
Any other questions? All right, I do hope this was hopeful. Over the next week, we're going to do 2 more training sessions, by the way. I'm going to do one specifically on the listing presentation because we're going to enhance it a little bit. This is going to be a little bit of long training. It's going to be more than 90 minutes, but I think it's going to be well worth your time. We're going to talk about the 9 C's. And the second one we're going to do is YouTube and video marketing because we spent half a day in California on this on Tuesday with some of the top people in the field. And it is spectacularly amazing. Some of these realtors in different parts of the country that went from 2 followers to 40,000 in 6 months. And the techniques they use to do it are just fascinating. So I want to share some of those with you. But we'll be doing that next week. And if you can tune into that, I'd love if you are able to pull that off. All right, then I will close this out for today. Any questions, please email me, or obviously, if you've got any lending questions, you can email Kate or Paul. I'd love to help you any way we can. And our goal is to try and get you up and running. And, for the second half of this year, first half was a little rough everywhere in the country. Second half of this year, let's try and pull in more of the business that exists. And thanks for working with us. We're going to do our best to help you. Thank you.